Yes, welcome everybody. As we called out for people to do extra talks, and I'm sorry we have the same, ostensibly the same lineup as last year, and I apologise for us being here. I keep on having to apologise for breathing. That's why I've got issues. Okay, so APTA is an organisation which, John, if you can just put that up while you're doing it.
Yep.
Your screen's on. So APTA is an organisation which is a band of people who do this for a living, either by trading their own money or advising other people. I advise people, and I trade my own money. And a number of people here are experts in their areas. We may have different viewpoints, and it's important to remember that the views here are expressed at this meeting are the views of the speakers and members only. They don't represent or reflect the views of APTA. APTA is a broad church. We have different beliefs and believe all people are equal under the sun. Under no circumstances does APTA endorse, approve, agree with, or promote the views of speakers or members. So we will deny whatever you say here today, and no, we won't. APTA doesn't provide any advice whatsoever. Can I unmute my call? Okay, APTA does not provide any advice whatsoever regarding any investment in any financial products within the meaning of Section 766B of the Corporations Act or otherwise. It is essential to note that speakers prepare their presentations without taking into account or giving consideration to the objectives, financial situations or requirements of any attendants at the meeting. Therefore, the views and opinions expressed by the speakers must not be considered by personal advice relevant to any specific person's financial position or situation. You can read this faster than I can speak it. Speakers and members represent their views for the purposes of education and exchange of views and discussion only. The views expressed must not be acted upon as investment, financial, taxation or legal advice or as any advice. Certainly you might take some of those ideas and look at them under your own methods or consult your own licensed financial advisor. Meeting attendants must consider the appropriacy of the views expressed in the light of their own objectives, financial situations, needs, position, and seek the advice of a competent and licensed advisor before acting upon it. The attendees at the meeting implicitly agree to release and discharge APTA from all liability, loss or damage that may be suffered or sustained from and indemnify APTA against any liability, loss or damage. Now, due to COVID, this presentation is free. We do this and we call it Forecast February, where we look forward into the future as we see it. And certainly John has extensive knowledge in the currency markets and equity markets through his work at Commonwealth Bank as the technical analyst, chief technical analyst at the Commonwealth Bank. And I've known John since, it must be 1986, 7, might have been 85 when Esme was there. And I just first started to notice the CBA chartist, which was John Gajewski, and he was excellent. I'm not sure what the schedule is. We'll probably go popcorn and people will choose to go in and talk. Larry is Larry Lavrenchik. He is one of the lead trainers for the Kaplan Professional Technical Analysis subjects and diploma, I believe, and has huge experience in a lot of different cycle work, looking at a lot of cycles, and also deeply into, what was the gentleman you used to use, maybe still do, Larry? Larry can talk a bit about that into the future.
Ichimoku.
Well, you're Ichimoku, but there's another cycles, a bit of cycles work you were doing. Anyway.
Oh, Ian Notley.
Ian Notley's work, yes, who was always Australian, actually. Very, very famous technical analyst, and he produced amazing work. I don't know whether his organisation still continues without him since he's passed.
Yeah, the firm is still going, I think.
Okay. And tonight, I think we also have Ken Henderson. You did an excellent presentation last year telling us the virtues of gold stocks, which has been very profitable. If we had followed his advice and listened to him, we would be way ahead in our gold stocks. in the major, aside from the Newcrest purchase. That probably, I think that's the only gold stock that's dead. St Barbara. Anyway, Ken can talk about that a little bit later on. I don't think Mark is speaking, and I always call out for new presenters to arrive. Don't be shy. There's probably stuff that you can teach me, Ken, John, and Larry that is way beyond what we've experienced or what we know, and your views are just equally as valid as ours are. So, if you want to speak, if you'd like to speak, the open presentation is open tonight, and it's open for the next 5 meetings that we have for this year for speakers. I like to see a different people coming along. We've had some excellent people last year. We've got a few more people coming up over the next 12 months, 11 months now that's left. And thank you for attending. It's great to be on. At some stage, we will be charging for this, and charging non-members for this. At the moment, due to COVID, we've done it for free, but we can't continue that forever. I think it's what, $97 for the year, is it, John? John's the treasurer.
That's correct.
It's ridiculously cheap for what you get, and you get to be a colleague of us, and we get to be a colleague of you. And so, who would like to start tonight?
I'll kick off. Bear with me. Right, okay. As David has read out the disclaimer, I won't go any further. But what I've done, I'm not talking about specific shares because it gets too much like advice. But what we'll talk about tonight is where we are, where the market is or has been over the last 12 months and before, and where I think it's going. And I've also included some of my speaking notes in there. So if you wish to look at the video later, then you'll get an idea of what's behind what I was saying. So basically, we're in a situation right now where it's all about maintaining confidence to keep the world economy going. I think most people would think we're in a bubble, and I think I'll be able to show that that the market has really flown ahead with the influx of money into the market. It's had to find a home, and it's gone into the share price in a lot of instances. But there's also a lot of difficulties going forward. We live in an age of a digital oligarchy. It's narrow casting of news with social media laws non-existent. You have social media companies now acting as gatekeepers to news and blocking those they do not support. And the US federal election is probably an indication of that, where Twitter, Google, Facebook blocked Trump, or blocked information on COVID virus, depending on what people were saying. Amazon, it blocked Parler, which basically put them out of business as an alternative e-media company. We have in the States the alienation and demonisation of 50% of the voting population depending on how you voted. It doesn't matter which way you voted, but I think that's a bit of a worrying situation. And we're also seeing that around the world. The UK with Brexit, France has got its problems. People are coming out and demonstrating about restrictions, etc., on COVID, rightly or wrongly. We've seen escalating violence, Black Lives Matter, Capitol Hill's rally. The Capitol building had been overtaken before by demonstrators, but not quite as violent as this, but there was never any arguments about it, as with the violence of burning and looting in 7 different cities in America. Nothing was said about it. So you have a deeply divided political divisions, and it has a destabilising effect on people and the economy. And therefore, it gets back to, it's a question of confidence. And history, from where I sit, has negative outcomes as such instances, and you can see it historically in Germany, Russia, and the Middle East. So I think, to me, it's a risk on environment going forwards. The challenges ahead are COVID-19. It's literally reshaped the world. Deep political divisions, as I said, and as with the new incoming US president, he said recently, if we don't act now, things are going to get much worse and harder to get out of a hole later. to that effect, as Trump went out, there was a 1.9 million support package approved. Biden has inferred there'll be another $2 trillion US dollars proposed for infrastructure spending. And if you look at Australia, if as an example, when lockdowns end and the world starts to come back to a new norm, consumer spending may possibly be unleashed. And that infers the potential for inflation and with major impact on dollar and equity markets worldwide. And it's also leading, if we get into inflationary period, a possible flight into hard assets and precious metals. But we look at hard assets, if you look at commercial real estate, they're potentially a bubble with WeWorks teetering on the verge of bankruptcy. If it goes down, commercial real estate, from where I sit, will probably be the subprime, what the subprime was in the GFC. Housing prices are through the roof. So, you know, to me, precious metals is one area one should consider going forwards. In the US, if we look at money supply, M1 money supply, it was up 70% a year. Even during the Y2K tech bubble, and 87 stock market crash lead up to it, the GFC. We've never seen money printed like this before, now, you know, thrown into the economy like this before. It's just unheard of. And it started before COVID. It started about September 2019. Money supply suddenly, M1 just went through the roof for no apparent reason, which I wonder whether or not there was some underlying issues within the economy, world economy, and reserve banks around the world. And it's just not America, it's worldwide. Money has been thrown into the economy.
One question, Ken.
Yeah.
One question. Are you intending to be showing charts with this?
I am. I'm getting into it. I've got a series of lead-ins, and then I'll start getting into specifics.
Okay, so there shouldn't be any charts showing while you're speaking at the moment.
There's the M1 money chart should be up.
Okay, you might need to share your screen because we can only see you at the moment.
What, you're looking at me? Oh, it's a horrible thought.
Oh, you didn't know that.
No, I'm thinking I'm talking to, righto, well, I'm having trouble.
You just hit the share screen button on that control panel.
We think you're sexy, Ken. I do.
Yeah, well.
And then select the screen that's got your chart on it.
Right, and I get host disabled participant screen sharing. Okay. What am I? I must unmute myself. I've done that. Make host.
Let me have a look.
Up my presentation. So hang on. I go to share screen.
I can only look. I'll tell you what. I'll make you a host.
Are you? Okay. All right, sorry about that, people, because I've been talking to charts.
Okay, try that now, Ken.
Share screen. There we. That should be it. How's that? People seeing the screen? Should see the disclaimer.
Yes, that's it. Terrific.
Right. Okay. Well, as I said, it was all about maintaining confidence. It's like the, Alice in Wonderland and the wizard behind the curtain. So that was basically my lead in. And I talked about the age of digital oligarchy, the challenges ahead. And then I was talking about the M1 money supply with being up 70% in a year, and you can see it's unprecedented. Just, you got to go back 50 years and you've never seen this sort of money printed before. Same with M2, money supply has gone through the roof, you know, in the USA and worldwide. I looked at money supply throughout the Western world, and it was the same. Well, not even Western world, China, Europe, Britain, Australia, the whole world's been throwing money into its system. But at the same time, we're seeing velocity of money is literally falling through the floor. If you look at around the GFC period, you know, the velocity of money didn't stop the way it has now. And you can say, okay, it's COVID, lockdowns, etc., closures of business. People are sitting on their wallets and then sitting on it very tight. But we look at it from a point, I look at it from a point of view as COVID releases. And if you look at Australia as an example, we should, hopefully the rest of the world will start spending. People will come out and want to spend if there's anything to spend it on. Looking through number of metrics that I came along with, if you look at the technology sector now, it has $1 trillion of market cap with negative earning. It even exceeds the Y2K tech bubble. It's not everything perfect out there. If you look at S&P price earnings ratio, the only time it's been exceeded these levels currently now was during the .com bubble. It never exceeded it any time before since the beginning of the last century. Not to say that that figure mightn't go higher, but to me it's a warning. Take care in the market in the future. If you look at small cap core buys as a percentage of New York Stock Exchange in volume, it's at an all-time high. Never been up there like this before. Well, that's probably all the young people sitting at home doing their day trading or whatever, and thinking this is an easy way to make money. It's, I just keep doing it, buy the dips or whatever, or buy GameStop or now silver potentially. You look at the Buffett indicator. It's never been higher. This is what Warren Buffett decides on whether to buy or sell, and how he makes his moves in the market when he's looking for companies to buy or sell. It's high. It's, everything is off the charts. You look at it, the under and over valuations. There's a deviation from 77% mean ratio of a Wilshire 5,000 to the nominal GDP in America. It's on levels that are unprecedented through modern history in the last 50 years. And euphoria. You look at the euphoria in the market. Everyone thinks it's, stocks are always going to go up. And you look at margin debt, it's at record levels. It exceeds the .com, it exceeds the GFC, and it just keeps rising. Even during quantitative tightening a couple of years ago, throughout the QE quantitative tightening, it just keeps going up. People are borrowing money to play the game. To me, I just find it when you look at all these indicators, and it's scary. I thought, well, let's look at some of the FANG stocks, and you've got Facebook, listed around 2012, it just keeps going up. You'd say that's a nice chart. Maybe it could come back a bit, but nothing to worry about potentially. But you get to Amazon, and that starts to look like an exponential blow off, and that would give me concern if I was, when stocks go exponential, they can go exponential, they can keep going for a long time, but one day they'll go pop, and look out if you're on the wrong side of a trade. That's all I can think of. I look at Apple, same thing. It's going, that exponential curve. It would be a worry. I would be taking money off the table if I was in a stock like that. I wouldn't be trading it, or I'd have tight stops. Netflix, risen quite strongly as well, but it's benefited from the lockdown with people subscribing to Netflix. But that's, let's see how that goes. We look at Google, same sort of thing, rising very, very steeply, and seems to be getting more steep all the time. And then we get to the darling of the EV, electronic vehicles, Tesla. That's just to the moon, Alice, to use a Jackie Gleason term for those old enough to remember the show. And there's GameStop. This is where the young day traders, or the day traders, came in and decided that it was 140% shorted to the number of stocks that existed. So they decided to buy it and force the hedge funds to cover, and cover they did. On the research I've been able to do, it would appear that there was something like at least two online platforms. One was Interactive Brokers, and the other was Robinhood, who had found themselves in difficulty. A number of hedge funds blew up.
TD Ameritrade also.
Ameritrade also. I thought Saxo might have been in that situation as well, because as of Friday 4:30 p.m. I couldn't get any more data. But it turned out it was a licensing issue, which I had to sort out, but I had to agree to something. So, but it was a private company, so I couldn't even look at the stock price. So yeah, number of hedge funds, they tried to ban the short the young people buying, that was blocked. There was an outrage, and they've had to back down on that. But yeah, and now there's talk of silver, which is interesting because I've had a number of people come up and say, "Oh, you know, Ken, silver's a good buy," and I'm thinking, "Oh, really, is it?" And even my daughter came over on Sunday, who doesn't take any interest in stocks, and said, "Oh, Dad, you should be looking at silver." And I'm thinking, well, you don't read the paper, you don't watch the news. Everything you get, it must be word of mouth or off Facebook, but you're saying, "Oh, yeah, you know, it's," and I'm thinking, if that's what young people are thinking, well, it's going to be interesting going forwards. Now, looking forwards, we have the Biden-Harris solution, and as Biden has said, there will have to be big decisions made, which people may blink at, but it's all about spending money to keep the economy going. And if you look forwards, we're told the money supply will continue to grow. If I'm going too fast, let me know, but I've got quite a few slides that I'm trying to clip through here. You've got nominal interest rates and real yields suppressed or being forced lower. You've got attempts to weaken the US dollar without disrupting the financial system. You've got fiscal spending increases and more directly directed money, such as into infrastructure in the States. You've seen it here in Australia, you're seeing it in Europe, you're seeing it in the UK, and you're seeing it in America and in China. And I assume the other countries of the major economies of the world are doing the same. And that's more, there's modern monetary theory, MMF, which is now being talked about, where it's you print the money to give people a livable wage. You don't address the disconnects within. You just print money and everything's going to be okay. And if, you know, it's like in China, if you're a model citizen, you'll get the money. If you don't, you won't, sort of thing. And it's very, so it's basically a lurch from the right under Trump to a lurch to the left under Biden-Harris. And under these circumstances, one could expect that commodity prices may rise to reflect this. And this is a chart of the S&P commodity index to the S&P 500. And John and I have both put this up on previous presentations. And basically it bottomed around 2015, 2016. And everything said in the last 50 years, the price of commodities have never been cheaper in relationship to the S&P 500. So one would have expected prices to start rising. And if you look at the Bloomberg's commodity index, yes, it is breaking out up from that wedge. From a TA point of view, there's a lot of work between that 90 and 80 level to break through to confirm that it's really going up, but it is breaking upwards, although early. I look at the commodity index, and if you look from May last year to present time, it's gone up 12.47%. If you look at food, agriculture, it's gone up 32%. You know, biggest problem that agriculture has had is that getting people to be able to either plant the crops or harvest the crops. In America, a lot of stuff was ploughed back into the ground. I know Australian farmers have been screaming as well about getting, with no backpackers, and the Pacific Islanders not allowed in until recent times again. They've had trouble getting staff to people to pick the crops. So this obviously will reflect in food prices as there would be scarcities, and that's understandable. And I came up with this chart where if you, hang on, I'm just too much coming up on the screen. If you run your eyes through it and skip Bitcoin and Cryptocurrencies, I'm really not interested in them myself. It's electronic money. And you find throughout the world there's starting to be restrictions within the banking system. If you want to move money into and out of cryptos accounts through the established banking system. But you run your eyes down the right-hand side, and there's a change on everything with the exception of the US dollar, which has gone, trade weighted index, which has gone down 11.1%. And if you bring that up as a gold versus fiat currencies, and it's a lousy chart, but I think it's a good indication to show that gold is effectively rising against all currencies. And if you look at it in a table format, you can cast your eyes down the second column in the Australian dollars. And if you go back from 2006 until now, gold has averaged 8.5% appreciation a year. There's a drawdown in 2009 of 3%, and there was quite a substantial drawdown in 2013 when gold got pushed down through the $1,300 bracket. And but even so, in the following years, because of I would think our exchange rate moves, etc., would have helped us there. But if you look at the US dollar column, the first left-hand column, gold went down for 3 years. Then recovered, went down again in 2018 a little bit. It's down a little bit this year, but the year's only early, but it's averaged 9.4% a year. So, people have gone chasing dividends. You could have bought a chunk and buried it in your backyard, I suppose, and done just as well and worn a little bit of risk, but it's, they're quite impressive figures, I think. If you look at interest rates, US 10-year Treasury bond yields appear to be rising now. Now, whether or not that continues remains to be seen, given the policy to keep interest rates low. But one never knows with interest rates. They may not. There might come a point where they're unable to control them. They look like, to me, like they're starting to break to the upside. And if you look at gold bullion, inverted, the inverted access to 10-year real interest rates, it actually tracks them very well. This chart's not quite up to date because that rise in the right-hand side is not reflected on this chart. So there's a divergence between the two. So either interest rates, bullion has to go up, or interest yields have to come back down again. So, but yeah, if you want to have a good an indication of where gold is going, look at the 10-year bond rate yield. If you look at the price of gold, it's, to me, that's still in an uptrend. You had the 80s peak, you had a 20-year down sideways move before it ran up to 2011, down to 2015. And 2016, it started to rise, and it's actually taken out that previous high, and it's doing a lot of consolidation around these prices. If you look at ETFs, looking at the left-hand chart, if you look at world ETF holdings, which is the grey, they're tracking along with gold price. So gold goes down, ETFs go down, etc. But if the interesting chart is the right-hand chart, which is annual global gold ETF flows, and the flow into ETFs for gold has never been greater. So there is money flowing into gold, and it seems to be some of it's flowing, quite a bit of it, I would say, is flowing into ETFs. Physical, one doesn't know because I don't have those figures. If you want to look at a gold chart from 96 onwards and then overlay from 2012 onwards, there's a correlation between the two charts, which, if that correlation continues, would infer that gold has got further to go on the upside. But there's no guarantee that will happen, but that's would appear to me that's where it's going. Likewise, if you look at this chart, there's a pattern back around 2000, which was formed, when a similar pattern is forming again now between 2012 and now. So one would think, one would expect if there's a breakout above that top right dotted blue line, then one would expect or reasonably expect the price of gold to continue upwards. if you look at the long-term price movements in gold, and on the left-hand side at 0.1, you had a 7-fold increase between early 1970s and 1975, then it corrected. And then from 1976 to 1980, you had an 8-fold increase up to $800 an ounce. Then it corrected, and you have to come back to 1999 where we hit the previous, hit a low, and then up to 2011, you had an 8,000. So each move has had a 7-fold, 8-fold, 8-fold increase. 2015 onwards, we're currently looking at a 2-fold gain. Will it go higher? Will it do what it's done previously? I don't know, but only time will tell if this current move reflects previous moves. If you look at the Dow Gold ratio over 200 years, up until the US Federal Reserve was formed in 1913, which is the said vertical red line, gold was very much tracking a channel. Since then, it's gone to extremes above and below. And you could argue now that there's a wolf, what do they call it? A wolf, I'm not quite sure what the terminology is, but if you look on the right-hand side, the size of the moves have been quite substantial to the downside. We're currently sitting on the trend line, bottom edge of the green trend channel. But if that breaks, if gold continues to rise or the Dow falls, then we are looking at a potential sizable fall in the stock market itself, which historically operates inversely to the price of gold. Gold Dow ratio now is 16 to 1. In 1980, it was 1 to 1. I think with my share portfolio, if I saw prices dropping below that green channel and heading south fast, I would start to look for a point where I could start offloading some of my assets. If you look at gold silver, the gold silver ratio is around, I think it's around 60 or this is 68, but I think it might be 60 now. I'm not quite sure. It was at an all-time high of 114 to 1. From just a counter-cyclical point of view, you would expect when silver was so cheap in relation to gold, but you would expect a cyclical move to the upside in silver. And if you look at silver to money supply, it is exceedingly cheap to the amount of total money, M2 money supply that's out there in relationship to the price of silver. We've seen the increase in silver recently with the GameStop crowd saying buy silver. Remains to be seen whether or not they'll be able to run it up. You must remember that the London Metal Exchange and COMEX have the capacity to increase margin deposits on futures contracts. They did it to Bunker Hunt, which sent him broke. Literally, if you look at the silver price to the left-hand side in 1980, that peak at $50 was a short squeeze by the Hunt brothers. COMEX then brought in, or our regulators then came in and raised the deposit for a futures contract, and they also said that Hunt couldn't buy, he could only sell, which basically forced him to liquidate because he didn't have the money to cover the deposits. And then silver went sideways around $4 or $5 right through to 2004 before it rose up into 2011. It's fallen back again and is now moving up. And this is as of last Friday, this chart, I believe silver went down a little bit today. I'm not sure. I think it's silver's $28. I think it, but there, the talk, is that if it cracks 30, well, I'd be more inclined to say if it cracks 35 and holds, then it'll be a potential good ride. Just a pattern on the silver price, rounding base, doing it again. Will we see $50? Who knows? If it cracks $50 and holds, though, I think silver could be an exceedingly profitable trade. If you look at the ETFs on it, left-hand side chart, the world ETF holdings are rising steeply, but the silver price is not rising to reflect it. And on the right-hand side, the ETF holdings, the annual change in ETF holdings is massive. So people have been and are going into silver. So this is 2020 figures. It's not reflecting the current issues that are facing silver market. Yes.
Can we wrap up in a couple of minutes?
Yes, mate.
Sure.
Platinum and palladium. If you look at it, if you put a ratio in there between the two, platinum to palladium ratio, platinum is cheap in comparison to palladium, but the same sort of situation existed with gold, where you go back a couple of years ago and palladium was far cheaper than gold, and now it's probably $400 an ounce US dearer. And platinum has seemed to take that discount to gold, but it looks like it's breaking up. I'll skip that chart. And as I said, it's all about maintaining confidence. If we don't act now, as Biden said, things are going to get much worse and harder to get out of a hole later. And that's money printing. To me, that's inflation. And to quote Voltaire, paper money returns to its intrinsic value, which is zero. So modern monetary theory, it'll be interesting to see whether or not, how this all pans out. But I'm a gold and silver bull. So, and that's my presentation. Thanks, John.
Terrific. Thanks, Ken. Does anyone have a question? If you do so, just unmute yourself and please ask it.
Probably not. Probably we better go on to the other speakers because I went a little bit longer and we're a bit slow.
No, I've got a question, Kendo. You say if WeWork goes down, then properties,
Commercial property.
commercial properties.
Why do you
WeWork, say that?
WeWork is the largest commercial leaser of property in the world. They borrowed billions to set up, and what I have read, if they go down, there will be so much property on the market for lease that it will cause a slump. You've also got the problem that SoftBank in Japan has lent it's bet its loan book on WeWork and the IPO, which didn't happen. And if WeWork goes down, SoftBank goes down, which is then an impact on the banking system worldwide. So it hasn't happened. I expected it to happen last year, but it hasn't happened. So I think it's being held up. But they are closing offices down. I know that the industry is very strained because I have a daughter who works in it, in the serviced office industry. What else? It will bust the commercial office space at a time when people are already looking, business corporations are already looking to downsize their requirements for office space.
Thanks.
Does that make sense?
Yeah, it does.
Terrific.
Okay, well, I'll bounce out and hand over to the next speaker.
Okay, we will I'll give you my yearly dose of Elliott waves and look at some of the key markets. I started off, a friend of mine sent me an article about how the some guy's view was that the US dollars needs to go higher. So as a good chartist, I pulled up a chart, which I hadn't looked at this one for quite a while, and looked at that and saw, yeah, there's some nice interesting developments there when I look at the chart. You know, we're currently, for the last 5 years, been sitting above those 2009 highs, and notwithstanding the market easing here at the moment, that there's a reasonable good chance that it holds those highs of 2009 and 2010 and bounces back up. I thought I'd go do the wave counts on that. And the problem that comes up is that the rise off the low can only be counted as a 3-wave, which means this entire move up has just been corrective, and we should ultimately be looking at lower levels again under those 2007 lows. However, whether the current move is the move to push it down there, yeah, it's still not pretty clear, because that action from the 2017 high can equally be counted as a 1, 2, 3 or an ABC. So really, I think the immediate focus this year is going to be, well, how does the dollar index behave around that 86, around that 87 mark? Do we do a good solid bounce and then push up above that 95 level? If so, then the odds will certainly look like that we're going into a double 3 scenario, and the market pushes up above that 104 highs that we saw in 2014. But short of that, then we've still got to keep open that the possibility that this move down over the last year is just the first stage down. So I went back and said, well, look, I wonder how it looks in the longer term. So here's a yearly chart heading back to 1979. And what caught my eye here about the last 5 years of action here is this very solid red candle coming down off the high. And this retest of the high is also a fairly negative looking candle, suggesting at this stage, suggesting more lower levels than up. So this is rather interesting now, because here we are back in the mid 80s high. David, you remember cutting your teeth on those few years there as the dollar fell away quite strongly. But putting the wave count on back that, what you see is a series of 3 waves. So my inkling here is that whatever started here in 1985 looks like it's a very long-term falling wedge, or terminal wave, as Ellioticians will call it. And with these 2 very negative candles, the possibility that this is the final wave down, take out these 2009 lows and finish off this entire move down from the 1985 high. So interesting situation for 2021, sorry. Do we hold around that 87 level and have another go at the upside, or are we going to, are we more in a situation like we were in 2003, or maybe here in 1985, 86, that the market's actually starting a new longer term wave to new lows, which will take a few years to get there. So at this, interesting times for this year. I must say, I think for me, it's a 60-40 bet to the low side. That this looks all very nice for a neat, clean completion of this terminal wave pattern, with a brief look under 2000 to finish off that move. Just having a look at the daily chart for this year, for the rise from that early 2000 high, and what we're seeing is not quite a completion of the 3rd wave yet, of the 5 waves down yet. So we've got a 3rd wave finishing here at the beginning of January. So initially we should be looking for pushback up to this 92.5, 93 zone, and then push down again. I noticed the wave 2 was fairly complex, so there's a probability that due to alternation, wave 4 will be fairly crisp and clean and short-term in nature, and we'll see the push down happening fairly quickly. So looking over February into March, a higher US dollar, but beyond March, you're starting to look to the downside again and looking for that challenge of 87. So I decided to have a look at that other currency, otherwise known as gold. And this is, I look back to this 1932 low and just saw how we are in the longer term pattern. And there's certainly a case there that we're since 2009, since 2002, we're sort of in a long-term 5th wave, and within that, with the market last year pushing up into new highs, possibly the 5th wave of these sequences from your 2002 lows and from your 1932 lows. Taking a closer look at from the last low, this 2015 low, yeah, it looks fairly bullish run up through here, and definitely a very corrective swing down off this high. So at this level of analysis, it does look that we should be looking for any downsides to be well supported around these sort of levels here, and then the market continue on and push on to new highs. However, when I did the wave count, it wasn't that clear because it was very difficult to get a 5-wave sequence in that first rise off the low. And in these rallies since late 2018, again, it's difficult to see each of these segments as 5-wave structures. So immediately what we're looking at the possibility here is that it's a corrective sequence, that all of this move up into this high could well be this part being, again, all 3-wave sequences. So A, B, with wave C being the diagonal triangle or terminating wave. So the implication, so the implication for that here is that what I've marked wave 4 here may not be the 4. In fact, the wave A of a larger 4. And when I look at in terms of alternation, I mean, 2 is very short. It was deep in terms of wave 1, but very short in time. So getting a very lengthy wave 4 may be the way to go. So what the implication here will be that the risk of actually heading back to close to 1,000 over the course of this year before we resume that rally up into new all-time highs. So I think, yeah, very important to look at over the next few months to see how the market here is going to work its way out. Now, at the moment, this rally here off the low failed to take out the last swing high. So quite possibly what we're already seeing that this move here is an A. We might get another swing back up into these sort of levels to do an ABC for a wave B, and then get the secondary drop down to down into these, 1,660 sort of area to complete an ABC and then try to attempt higher. Or rather than moving higher, for these supports here to give way. So yeah, I think the it's 1650 that will turn the immediate outlook very bearish if we drop under that. So I think that's the scenario for gold is a bit of sideways over the next month into March. We're looking March, April. You're probably looking for lower levels, and then the interesting action will start. Will gold prices rally out of here to resume this major rally uptrend, or whether they falter again, which will be our indication that expect some more downside. And certainly any firm break here under 1650, I think you should look for an immediate drop back down to these lows. But whichever the outcome, we are still looking for higher levels in gold before you get any long-term weakness in the gold price. So if we now go to the Aussie dollar, the other side of the US dollar coin, yeah, you know, we've had the Aussie dollar declining since 2011. The sequence there, very much a corrective sequence. The COVID brought this exhaustive drop back and an immediate rally through that last swing high. And since then, we've held above that high to push on higher again. So this is all looking in a very good position to challenge this high here just in the low 80s to confirm that. And when we can push above that, then we get our confirmation that this sequence here is indeed over and we should be looking for higher levels. But at this stage here, it does look like, you know, we had a big low here back in 2008. That's now the market here went through that low and immediately snapped back up. So, yeah, I think the chances are pretty good that in the years ahead, we're going to see a higher Aussie dollar, which will fall in line with the US dollar index heading down to new lows. So moving forward from the current area, you should expect a rise in the low 80s, probably a correction back down to the mid 70s before the market pushes higher later in later years. Just looking at the way it's unfolding here, the best wave count I can get is that we are now getting into the final stages of the rally up from the March low. It is the best wave is that it's moving in a 5-wave sequence, which is very good for longer term gains. But for this year, maybe a bit of weakness early February. Take out these lows briefly, certainly not to take out this 75-cent low down here, and then push up into a new high, probably in that around 80 cents low, 80s. That will then finish that sequence off, and then see a retracement coming back down to the 70 cents levels before the market stabilizes and tries that rally again. So that on the currency side, just having a quick look at the share markets. I showed this chart last year. This is the Dow Jones back from 1900, and the one thing that's caught my eye here, how not only is it seems to be this 10-year cycle in the price sequence, but the market tends to stick with a pattern for 20 years or two of these 10-year cycles. And well, last year was a centre point for one of these 20-year periods to finish. So the question is, are we likely to see a sharp reaction against this move, even if it is just a flat sort of move like we had back here in the 60s or 70s, or something deeper, or something a bit volatile like we saw in the 20s and 30s? But it does warn that for the time being, the upside somewhat limited. We need to see some downside action over the next decade before the market's in a position to start looking at high levels again. So bringing that down back from the 2009 low, we see that the COVID low just actually pulled in line with this cycle actually rolling over. So there's a very good chance that the low here implies higher levels for a couple of years. So we've seen the market go to a new high here already. Possibly this is now pushing out, coming to a top and easing back a little bit. But getting repeats of these sorts of patterns does look possible. To suggest that perhaps that the market will react down, I would think that a drop below this low here around 2,600 will be a sign that any upside is finished for the time being, and we'll come back to have a look at these low points down here. So that's just looking on this cycle pressure, which I found rather interesting last year, and again interesting this year. It's still showing a few more months in the upside. Pardon me. Possibility of running for a couple of months early this year before we push lower again. Putting in a wave count, the way best done, this is a wave 3, so we're looking for an interim high this year, a pullback, and still another high to come to finish off a nice 5-wave pattern from that 2009 low. So yeah, so for this year, it's a question of how fast will this market move, how deep will it go, where will that wave 4 be, does it need a couple of years to come down before the market pushes higher? On this sort of, where I've put these sort of labelings, if we go back to the cycle chart, then it'll be suggesting a high by mid-year this year, perhaps even a pullback to as late as, a pullback to either in the middle of 2022 or maybe even 2023 before we pull back up. Looking at the current rise that's been coming up since the March low, like the Aussie dollar, it really looks like it in its final stages. This one, more than the other charts, is suggesting do expect a high sort of like in the next month or two, and then the market to start testing back, coming back to retrace this rally. Once we fail to stay above recent highs, that will be a signal to firstly sort of come back down to these 30,000 levels in the Dow, and then later back down to 2,600, and later still maybe somewhat lower levels. So high early in the year, lower later. And what will that implication be for the Aussie market? Well, this is the long-term chart from the inception of the Australian Stock Market Index. What the exact wave count in these lower levels is up until the late 20s is pretty unclear. But certainly the wave count from the 1932 low is starting to shape up with the possibility that last year we actually saw the final high. And on the yearly chart, we've seen to have a nice pullback there. When we look at things a little bit closer, what we see is the rally from 2009 taking on the shape of a rising wedge, which very briefly went above the 2007 high and a strong collapse afterwards. So, yeah, this failure to hold the new high and this total collapse is swinging the odds in the favour of downside action. Notice how much room we've still got here between recent highs and last year's high. So there is scope that as the as the US share market rises, that the Australian market rise with it, but not necessarily to push out into new highs. So if we have a look at the wave structure in from the March lows, the COVID low, everywhere in there is really hard to find a 5-wave sequence. So this idea that this move up here is a corrective sequence has got better than even odds. And my best count of it is, yes, we are looking at a brief dip coming down early in February, finish off the correction off the highs here. This probably being an irregular correction, A, B, this being the wave C, and then we push up into new highs above these January highs, but not through last year's highs. Finish off the move, and then we start a bigger push down. So yeah, interesting times there on those markets with the US dollar, Aussie dollar really showing signs of big turnarounds, and the share market's showing at least some sort of high in the US dollar for this year, with the possibility of high levels somewhat later, but the odds being that the Aussie dollar, the Australian share market has seen its high, and despite any future rises in the US market, will probably lag it and not push to any highs. Out of all of that, the big interesting one for me will be the Aussie dollar, whether it continues to validate whether we saw a big low there early last year, and you know, over the next few years, you know, will we be building up the base for larger gains later on? So thank you very much. Have a fun time in the markets.
Thanks, John. Has anybody got any questions for John? Feel free to unmute yourself and ask. We'll just leave one or so minutes. Larry, did you want to go next, or?
Yeah, okay. Great. Okay. All right, just starting with the Dow 30. And as I've discussed many times in the past at these meetings, the basically long-term point of view, monthly charts, and I use Ichimoku. In the long-term perspective, the Kijun Sen on the Ichimoku charts is the main indicator that I'm using as a guide for primary bull or primary bear markets. If we go back to these two major primary bears from 2000, 2001 and 2008, 2009, we see that there's a pattern that these primary bears develop in with regard to the Kijun Sen. Kijun Sen is the pink line on these charts. And we get the bearish breakout and then a retracement back towards the Kijun Sen and then the strong sell-off. Happened here as well, breakout to the downside, traveled up through the Kijun-sen, but was unable to be maintained up through there and sold off, trying to find some support around that or resistance around there, and then selling off quite strongly down into these lows. So we're looking for that kind of pattern. That's my guide for these monthly charts with the Kijun-sen. It tends to be quite good with equities. With some markets, it doesn't work out so well. So just looking at the Dow 30 at the moment, this is up until the 31st of January. Is it? Yep. So basically, we're still trading above the Kijun-sen, the pink indicator there. It's telling me that this market is quite healthy. I'm not seeing any indication of problems. Obviously, back with the COVID sell-off, we did see a move down below that Kijun-sen. We saw a close down below it, which certainly did signal warning signs. If we look at all of this strong bull through this period here, can you see my cursor on the screen, guys?
Move it around again.
Yeah, see the cursor?
Yes.
Yep.
Just move it slowly. Just
right.
move it slowly, Larry, because if you move it slowly, we'll all be able to focus on it and follow your path.
Okay, so just from the left-hand side here, we saw multiple occasions. The Tenkan-sen, the green line here, the short-term indicator was finding strong support in a strong primary bull. And then when we had a bit of weakness in the Dow 30, we saw support coming in around the pink line, the Kijun-sen. A couple of closes down below, but certainly no strong bearish activity down below. And one probe down below there in about 2018, I think it was late 2018. So the COVID sell-off, we saw the close down below, but large black body candle, but certainly a large shadow on the bottom. Certainly did suggest that at the close of this market, the buyers had come back in, and it failed to confirm the existence of a primary bear when the market closed back up above the Kijun-sen in the next month. So a very strong buyback here, closing back up above the Kijun-sen, with the market then rallying above those previous highs. At the moment,
Larry, it was also a nice return to that old top, which you've got with the green line there. Isn't it?
Yeah, that green line was that previous high, and it
Yeah.
really did highlight how important that area was. So if we do see any sell-off in the future, any primary bear development, probably will have to be a primary bear if we get down that low with any strong selling and any major close down below there. That probably will be an area that we do need to watch. Just looking at the previous month for the end of 2020, we had a small bodied white candle. The small body does suggest that there's not a lot of net progress made by the buyers. They did close with control, certainly different than the previous large white body candle. And it was suggesting that there is a possibility of a potential sell-off. It will most likely only be minor at the moment, if there is. The black body candle closing for this January does suggest that that is a possibility. The sellers coming into the market, sellers closing with control. But what we tend to see in these strong bull markets, and that's what I would classify the Dow 30 as at the moment, and how I gauge that is the depth of the where the price activity is away from the Kijun-sen. We can see that it's a fair way away from that Kijun-sen. So, and the market behaves a bit like a rubber band, where it will move away from these Ichimoku indicators and move back to them and find support generally. So we're looking a little bit overbought. Some bearishness coming into the market, looking for confirmation with a lower high, lower low. And first area of support based on Ichimoku will be the Tenkan-sen. And that is if we see these strong bulls back to about the 2012, 13, 14, 15, we see that area holding a strong support. And then after that's breached, we look to the Kijun-sen. So looking for that scenario at the moment. So even if we do see some selling coming in, I'm not going to be too worried until I see a very strong negative close down below that pink line, which at the moment is at 24742. Now, another thing I'd like to use and does work quite well on a lot of markets is the pivot points, the yearly pivot points on the monthly charts. And just going back 4 of these back to 2018, we can see that the Dow rose on a couple of occasions to that first resistance level on the pivot points, and it held as a resistance. We sold off. The next year, we got up to the second pivot point level, and then the following year sold off, and that was the COVID year, the COVID low corresponding to that third pivot point support level, which corresponded to those previous highs, major support, and that's why we saw that spike there with the buyers coming in at that area. At the moment, and when we rallied to the second last candle here is the December candle, the first pivot point resistance level held as resistance. So moving forward, if we are going to see this market continue to the upside for the next year, looking at the first resistance level, which is at 34758 as a potential target. And then above that, the R2 level, the second resistance level, 38909. But more importantly, if there is some sort of a retracement, we have the middle of the pivot points, which is that blue line around where the Tenkan-sen is. So that is likely to make that a very important level if there is any first time frame retracement back to that area. So it will strengthen the potential for support around that 26,500 level. Next, going with the Fibonacci retracement, and just examining this first time frame uptrend that the market's been in, comparing that to the previous first time frame downtrend. So only one candle downtrend and 3 candles to the upside. And we have seen resistance coming in at the 161.8% level. With the selling there, this black body candle, it does suggest that there is a strong possibility of a change of trend only in the first time frame. So it adds value to the argument that we may see a retracement back towards this Tenkan-sen area. The next thing I like to look at are my bands. These are 1 standard deviation bands, and we see a very similar scenario as we see with the Kijun-sen, where we see a breakout down below the bands, and we saw this back in 2000 and 2001 and 2008, 9. And breakout down below, the market attempts to rally, finds resistance around that lower band, and then sells off strongly. Basically, this is I see this as a strong guide of strength in the market for trending strength. If we're basically seeing strong bearish activity down below the lower band, then we're seeing a very weak market. If we have strong bullish activity above the upper band, we have a very strong market to the upside. So that's how these strong primary bears or in this case primary bears tend to manifest themselves. So what we're seeing at the moment with these bands is certainly no indication that we are anywhere near what could look like a primary bear at the moment. We are trading in a fairly strong bullish manner up above, or previously for the previous couple of months, up above the upper band. We have seen that black body candle. Any retracement, we should be looking for the upper band to act as support. And as we see here, these upper and lower bands tend to act as areas of support or resistance. Often the area within the bands can act, or the middle of the bands, which is the moving average, can act as support or resistance. During this year, 2020, we saw that sell-off down below the lower band, but we didn't see the follow-through to confirm the primary bear, as we saw here previously, the strong bearish breakout, the retracement back to the lower band, and then the continued selling. So with the COVID low, we saw the strong breakout, but then we rallied immediately back up to the lower band, and then in the next month broke out in a bullish manner up to within it, and that negated any story for a strong primary bear. And then breaking out to the upside, coming back to within the bands, trading up in that upper half here, and a strong breakout with some follow through to the upside. So certainly no hint of any primary bear at the moment. Now, just looking at the US markets, and as quite a few have mentioned previously, I think David and Ken have mentioned the domination of the tech sector within the US markets. And here from the S&P, the tech sector really was king for the previous year, up 43.8% generally. And that really is where all of the action has been. The NASDAQ pretty much represents the tech sector. And looking at our long-term monthly chart, trading in a very strong manner, up above the Kijun-sen, remembering that Kijun-sen, that pink line, is my indicator for a primary bull or bear. Often we've retraced back towards it and bounced off it. And at the moment, we're trading in a strong bullish manner above it. Looking a little overextended in the depth of the price activity away from that Kijun-sen. So I will be looking for something of a retracement. The current candle has closed with a doji. We'll be looking for confirmation of a lower high and lower low for a potential retracement back down towards the Tenkan-sen, the green line there. That's the first area of support, and failing that, then looking for the Kijun-sen, the pink line at 9729. The sector ETF, XLK, the tech sector ETF, pretty much resembles what we've seen with the NASDAQ as well. So pretty much a mirror image with those areas of support, and the same scenario with the Kijun-sen being the primary indicator on a monthly basis. With the NASDAQ 100, the yearly pivot points have been important. They have held as important areas of support or resistance. Back 4 years, we've seen, or 3 years, we've seen the second resistance level hold. Then the market selling off at the end of the year to find support at the middle pivot point level, rallying for the next year up to find resistance at the third resistance level, and then at the start of the year finding resistance at the first resistance level, support at the second support level, and then rallying up at the end of the year to find resistance at the third. So moving forward, obviously targets here, if the market does continue moving to the upside over the next year, and that's not suggesting that we'll do it straight away, but looking to that first resistance level, 14,951. But more importantly here, similar to what we saw with the Dow, the middle of the pivot points, which can be an important area of support or resistance around the Tenkan-sen indicator, which does tend to be that first area of support in a strong bull market. So that's around the 10,861 level, around the 11,000 level. And we see similar scenario here with the sector ETF. Now, just examining the Fibonacci extension here, and I look at this in on a trending basis, on a first term time frame trending basis. All of this here, this final trend, is all one first time frame uptrend. There wasn't any correction through here, no lower high and lower low, all one uptrend. Previous first time frame downtrend and prior first time frame uptrend to that downtrend. So what we're seeing here is the 261.8% extension level come into play with the rejection above there. The market unable to close above there for this month. A doji candle certainly suggesting there is a strong possibility of a retracement, very similar to what we've seen with the Dow 30. And with the bands, with the NASDAQ, very strong bullish activity, looking strong previously on the bullish breakout, strong bullish white candles, a retracement back towards the top of the bands, and then the market moving higher. But the doji suggesting a retracement. So looking to the upper band, 11,504, or within the bands or the lower band as an area of important support. And before I see any significant bear, I've got to see this type of activity here, the market moving to within the bands, attempting to break out again, selling off and then breaking it down below the band. So no strong indication of any primary bear at the moment. If you look at the volatility, this is just the bandwidth here on the bottom sub chart. And we have moved in a, obviously volatility moves in a cyclical manner, and we have moved above the previous two peaks in volatility. So this certainly is suggesting that this uptrend that we've seen in the NASDAQ is probably a little bit overdone. So it wouldn't surprise to see that retracement come in. So when volatility will move off, it'll mean perhaps the end of this first time frame uptrend and the market taking a break as some sort of a retracement. And similar to what we saw with the NASDAQ is the ETF, the technology sector ETF. Over to XJO, the ASX 200, and this looks a little bit different. And back in 2009, we had a very similar scenario with the Kijun-sen being the important indicator here. Over the last few years, Kijun-sen hasn't been a great indicator. We've been seen the market hovering above and below the Kijun-sen indicator until probably the last few years, and then the market climbing above there and looking quite bullish above there. But we still haven't seen any strong bearish closes down below the Kijun-sen, and the market maintaining any negative activity as we saw here down below that Kijun-sen. So at the moment, it is still suggesting that we're not going to see a primary bear in the ASX 200. What is of concern, however, are these very small bodied candles over the last few months, large shadows on the top of all three, very small body on the last one there, suggesting there is very strong potential for a sell-off. The price activity is a long way above the Kijun-sen, and above the Tenkan-sen, and certainly that is suggesting that this market is a little bit overbought, and we should see some sort of retracement back towards this area, and that would be just a normal retracement that we should expect. Obviously, if we see any breakout down below the pink line, the Kijun-sen, and some more sustained bearish activity down below there, we could see development of this type of primary bear. Over to the pivot points, and these pivot points have been good areas with the XJO as well. 3 years ago, area around the first resistance level holding, and then the second resistance level the next year. For the COVID year, the first resistance level held right to the high, and then the low, the third support level, acted as a strong area that the market could bounce off, and we did see that, very similar to what we saw with the Dow. So moving forward, and as we saw with the other markets, with the Nasdaq and the Dow, that middle pivot point level around the Tenkan-sen. So this area here, once again, around the Tenkan-sen, is going to be very important to all of these equities markets. And to the bands here with the ASX 200, and we see this similar type scenario in the 0809 sell-off, with the breakout below, retracement, and then the strong selling below the band. We haven't seen that. We had the breakout for the COVID and sell-off, and then the immediate retracement back to within the bands was a little bit worrying when the market couldn't get up into the upper portion of that upper of the bands. But importantly, then the previous couple of, or the next couple of months after that, the bottom of the bands holding a support, and the market bouncing off there. What is of concern is the inability to break out above the upper band over the last couple of months. And this is suggesting that this certainly isn't a strong market as we've seen previously over the since about 2017 or so, and suggests that we certainly could see some sort of a retracement here, but no significant signs of this type of bearish activity that we saw back in 2008, 2009. Over to gold, and Ken's favorite. Gold certainly does respect the ideas about the Kijun-sen indicator, and we are trading above the Kijun-sen. When we saw these highs around the 2000 level here, we did see that spinning top candle, the market selling off. It was looking overextended in depth away from the Kijun-sen, and we have seen the retracement. Importantly, that Tenkan-sen came into play as support. It has moved up now, and it's just trading just slightly above the close of the end of January. So technically, just a slightly bearish market in gold in the first term timeframe. So we could see a little bit of weakness in gold, and potential for a retracement back towards the Tenkan-sen. The Kijun-sen, sorry, down to about the 1658 level. Importantly, these areas of support or resistance of recent times, the last month that had finished trading and 2 months prior to that was that previous important high around 1923. The market failed to move off there or past there on a bounce from above the Tenkan-sen, but that Tenkan-sen area coincided with these previous highs roughly, which were just below that major high. So that did suggest that there was likely to be strong support coming in around that area with the 10 consent trading around there. So if we are going to see the market move back down to these levels, just watching that that level of 1767 again, and then any bearish activity down through there could see us test to the Kijun-sen 1678, and any strong bullish close up above 1923 could end up testing back up to the 2050 level roughly. The yearly pivot points, and they don't tend to work fantastic with gold as they do with equities markets. We did see 3 years ago the first support level holding. We rallied very close to that third resistance level and sold off from there. And then for the previous year, last year, we saw the market getting up towards that third resistance level, but closing above there. So not working as well as we've seen with the equities markets. If gold does trade to the upside from here, looking to the first resistance level, 2172 as a potential target. But once again, we're around that middle pivot point level, which is fairly close to the Tenkan-sen, 1880 and 1811 for the middle of the pivot points. So down to about this 1800 level is an important area if we are going to see the market find support there, or if we do close in a bearish manner down through there. And just looking at a previous Fibonacci retracement here, they do tend to work pretty well with gold. This is on a log chart, so proportionately it doesn't look like 50% here, but this previous first time frame uptrend on the retracement that we saw prior to this last month, we held right at the 50% level, which coincided with where the Tenkan-sen was, so added strength there for support. And we did attempt to bounce off and have had confirmation of a first time frame uptrend with this current black bodied candle. And looking at the current retracement of this first time frame downtrend, with this current candle forming a higher high and higher low, we have tested to the 61.8% level, been rejected from there, and rejected from the 50% level with this moderately bearish indecisive type of candle. And it does suggest that there is potential for a change of trend in the first time frame back to the downside. And just looking at the previous Fibonacci extension, so examining this first time frame downtrend to the immediate previous first time frame downtrend, and support came in at the 261.8% level, which also coincided with the Tenkan-sen indicator for this downtrend that the market was in prior to the close of this month. And looking at the current uptrend, and we are looking at the some resistance coming in at 23.6% level, rejection from there with this indecisive type of black body candle, suggesting possibility of a change of trend to the downside. If the trend does continue to the upside, looking to probably this 50% level here, which coincides with the high around the 2100 area as being an important area to watch if the market does continue to rally here. And in a higher time frame, looking at the second time frame upswing here, with the second time frame downswing and this current second time frame upswing that the market's in, we have seen rejection here with this spinning top type candle from the 78.6% level. If the market does form a lower high and lower low and take out the low here from 3 months ago, then we will have a second time frame downtrend in play. And it will suggest an end to this uptrend and possibility of the market at least getting down to the Kijun-sen area around 1658. And to the bands with gold, and very, very bullish market, looking very overextended. If we look at the depth of the bands here, the width of them, they're very wide, suggesting that this certainly has been in the run up here from these very narrow bands with this strong breakout. A very strong uptrending activity in the market certainly is either having a bit of a break, there is a possibility of the market testing down to these lower levels. 1681 is the middle of the bands. That's a possibility if we do see a sell-off. That upper band in this current month just coming into play, the top of this band coming into play as some support, but just watching closely whether we do continue the trend to the upside or not. This cyclical activity in volatility is suggesting that volatility is probably likely to continue to come off, and it is some sort of an argument against the market trending up immediately here. Probably more likely that will come off. The market will either hang on, got a text from John. Time. Okay. The market it will either move sideways or we'll see that retracement. To the Aussie dollar, using the Kijun Sen as our important indicator, we are trading in a bullish manner above the Kijun Sen, suggesting a fairly strong bull. The depth of price activity away from the Kijun Sen and Tenkan Sen is strong, looking for a retracement with a black body candle, almost a harami type pattern, and potential for a change of trend. Previously, we have seen the cloud come into play as resistance for the Aussie dollar. So that may be important here for us with this small black body looking for a lower high, lower low, and for the Aussie dollar to move back down to the 10% support around the 71 cent level. I won't go through into the pivot point levels or into that. And just looking at the bands with the Aussie dollar, previous strong bearish activity down below these bands certainly does highlight a very strong downtrend in place in these on this occasion and this here. Strong bullish breakout up above the upper band in 2020. Retracement back towards the upper band and finding support within the top level, breaking out with two very strong bullish candles. It does suggest that we certainly may see further development of this trend to the upside after we see some sort of retracement, perhaps back to the top of the bands, which with the band series about 73. So that's it.
Okay. Well, thank you very much, Larry. Does anyone have any questions for Larry? If you do, just unmute yourself and ask your question.
Just want to make a statement, Larry. When I watch you, it's just wonderful to watch the way you assess things with your Ichimoku. It's just, it always reminds me of how much I should look at it. I do on occasions, but not as much as I should.
We always see eye to eye with these markets, don't we, David?
Okay.
Sometimes.
Sometimes we always sometimes do.
We always sometimes. John, was it?
There you go. It's all yours, David.
Okay. So welcome to 20. We'll talk a little bit about 2020 and we'll what I was thinking last time, and we'll look at our agenda 2021. I want to be like Klaus Schwab. Now, this is important that politicians, social media robber barons lie, and they make lots and lots of money, a lot more than we do. But charts don't lie. Beautiful exposition of Joe Biden's ability to lie in a body language thing from a young chap that I followed on YouTube. Look it up. It's very educational about lies. What we've seen here is, John, do you mind muting yourself so that I can, because I get disturbed by the sound.
Sorry. I can see your screen full on my other screen.
I get that. Can you mute yourself? Because I'm hearing.
Okay, I'm sorry.
Yeah.
We'll do so.
Yeah. Okay, thank you. Sorry, just get a little bit distracted easily. So as I said at the start, back in 2003, I was told about a thing called the system, which was a supra-government body. And this was by a gentleman in Hong Kong who had met a person who was called the gateway to this. And it was run not by government, but by billionaires. And it invited people in. For example, It wouldn't let Chinese billionaires in at the time because they weren't of the right quality. And this gentleman also told me that they wanted the Chinese yuan by 2020 to be the currency of trade for the world. So the world reserve currency. Unfortunately, Donald Trump got in, and that's what caused all the problems, George Soros and the Chinese. And this sounds like conspiracy theory, but it all ties back to what I was told in 2003. Didn't want Trump in because he didn't like China and he gave a lot of pressure. So they immediately started working the propaganda machine against him. And of course, they roped in the other billionaires, which are the social media robber barons, the social media oligarchs, who don't care about anything but have all your information, which you've given for free in the benefit of using their software. Tonight, I'm using Microsoft's PowerPoint, and it keeps on going down on me. I don't know whether it's got anything to do with what I say. I try and speak my own truth and not as according to social media. This has been called the Great Reset. And in the start of the year, last year in 2020, I said we're being lied to on a scale we've never been seen before. What we saw in the elections, as Ken was alluding to, you look at the videos of things, and you see peaceful protests, and behind, buildings are going up in flames and bombs are going off and people are smashing windows and hurting people and abusing people. So they lie in words, but the pictures don't lie. I don't know why I've been given something on the screen here. I want to get rid of it. And it's probably a little warning. You shouldn't do this because this is Chinese-based webinar software, Zoom. Anyway, The Great Reset was written in a book by Klaus Schwab, who is the head of the World Economic Forum. If you want to go and look at their website, you'll see people like Prince Charles, Alan Joyce, all talking about the need for a great reset. These are people who run airlines and about the environment, and these are people who live in 30-bedroom palaces and have different palaces to go to and lots of servants around. So they also have a very small carbon footprint. This is the Great Reset timeline for Canada. This was leaked from the Canadian government in October 2020. And if you go back through it, you will see the timelines are, if you want this, I won't bore you with it, but basically they've ticked off all the timelines. Rush the acquisition of construction of isolation facilities across every province and expected by December 2020. Early January, complete and total secondary lockdown, much stricter than the first secondary rolling phase. You'll notice that during that early lockdown, Justin Trudeau was flying out to Barbados when he wouldn't let anybody else come to Canada. Now, I'm not going to get into a political discussion, but this is just what is happening. And they have projected forward, the Canadian government, exactly what they will be doing to the general population in order to control them, to ensure compliance with the Great Reset and making sure we're compliant and docile and not complaining about being locked up and held inside our own countries with no freedom, and probably states or cities. Now, to the extent this affects the world, my forecast when I first learned about COVID was that by 2021, we should start to see the markets, middle of 2021, the markets to start to come out of a bear market cycle because of COVID and the pandemic. Now, when you throw into everything else, they're looking at a world debt reset. It's called the Schmettier cycle. We are in that 7-year cycle. The last cycle was 2014. This year is 2021, and it starts in September 7th, the Schmettier cycle, which means basically debt forgiveness. Back in 2014, I think there was a number of haircuts taken by investors in Greece, Cyprus, and a whole bunch of other countries that were overborrowed. And the haircuts around that time, 2013, 2014, were a bit savage on investors. Now we're going to see, if you note along here, this is part of the program that was issued by the Canadian government and secretly found out. So basically, there's a debt reset, which means what they're intending to do is to take away all of our property. We don't have any. If you look at Klaus Schwab's plan for 2030, is by that time we own nothing. We rent everything off somebody that may be Amazon or Jeff Bezos. We don't own our own clothes. We don't own our own properties. How they do that is going to be amazing to watch. So just watch this space. And it's all in the plan, and they've been talking about it for ages. So based on the NASDAQ, and this is about the US markets, and this is my disclaimer in warning as I'm licensed, and you've already read that, and I'll move on. It's very sad, and I said this at the end of last year, how bad without Trump will all these comedians be. You know, that sad Stephen Colbert will just be hopeless. Now, we had some forecasts. The important thing I watch often is the hemline indicator. Dawn Bolton Smith told me about this. When I go out, I look at shorts, see how short the skirts are. They're still short. So Larry's idea about the Ichimoku charts showing a continuing bull market also stacks up. Economically, I watched a cycle called the Tritch cycle also, which is something Dawn Bolton Smith talked to me about. Basically, economically, topping in 2019, the economy being a bit dismal till 2023. So generally, the stock market bottoms 12 months in advance, but with all of the money pumping we've seen, it's hard. I still think we're going to get a bit of a shock. We're actually in the time right now over the next 3 weeks for a shock. We already saw the first foray. Whether it's a sideways movement or a mini bear market is another matter. But I don't think we're going to go. We may just tag new highs over the next little period, but then we're going to have problems getting higher over the next couple of weeks. So economically, we're in that recession. We should see a good boot scoot and rally up into 2033 economically, with a little bit of a relief rally in 2026. I'll just move through quickly. I don't think I might have the mass pressure chart for this is what the US election was. I went quite bullish on the US stock market back in the end of October. I said to everybody, let's buy, let's go for a run. In September, I was also bearish. And so generally after a good run up into the election, after inauguration, there's a honeymoon period. It's called the 100 days, first 100 days, that sort of time, where the stock market has another go, but it fails from there. So we're in that phase now. This was my forecast for last year. It's called the Dow Jones Mass Pressure Chart. It's a technique I would learn from W.D. Gann. I actually buy it directly from the gentleman who was taught by W.D. Gann, a guy called Bob Corder. Now this called for a top, basically February. We got the top in February and shorted it for the Profit Hunter Group and had a beautiful, beautiful trade. It lasted longer than I thought. We went into the March period, and then we thought it'd be good for the rest of the year, and it was. So so that was a really good trading year, and I managed to call Qantas, I think, down to, was it $3 or $2? Anyway, I didn't get to buy there, but I got some at $3.50 and it got revived, and I like trading Qantas. This is the forecast for the Dow Jones Industrial Average for 2021, which is a high in late January, a low in late May, a high in late August, and then a bit of a decline. Now I prefer these to be timing rather than pattern. So we might get a higher top here, but the timing is more important than whether it makes a new high totally. So that's kind of the way that's the way I like to do this. And then I look for the normal patterns that we work for. So that's the generally for the Dow Jones Industrial Average. Obviously, the people who are the biggest thieves in the world are the ones who make the most money. They're including Jeff Bezos, who looks very strange and has one of the most beautiful women in the world. And look out for how much money she takes in for. It's just going to be classic to see, but he probably won't give a shit. Bill Gates didn't have the lesson. So what I wrote this before was that my conclusions for the US market was that we would be looking at skullduggery in the next couple of days for because the Davos meeting, this is from directly from my forecast I give my members. So the Davos meeting, I thought we might get a sell-off. So we got short, we got a good decline, we got a good move down. We got short the Aussie ASX, we got short the E-mini S&P, and we've been stopped out for a profit on these moves. We took some profit on the way down as well. We bought the volatility index, and that spiked up from being when we bought it 23 odd up to what was it 35. We got out at for 1/3, and so we've made some good money out of these recent moves. I think what we're seeing currently now is a bit of a rally that is probably going to be a bit short-lived. I've got the silver chart up here. I'll talk about that a little bit later on. But here we can see that we're rallying at present, and we should probably come back up to about 38.30, that sort of area, before we get more downward pressure towards 36.18 for a completion of a fourth wave pattern. And then we start up again, because the money pump's not going to stop with Joe Biden. Janet Yellen's already been bribed about 800,000 by a company called Citadel, which actually has as one of them advisors a person who is called, what was his name? Ben Bernanke, who used to be head of the Federal Reserve. Janet Yellen, of course, has been paid something like 28 million bucks for speaking to investment banks and making sure they've already paid her in advance as US Secretary to the Treasury now. So well paid off. We've got some really well paid off politicians. BlackRock is now able to borrow directly from the Federal Reserve at the discount window. So they can borrow at 0% and buy bonds at 1 or 2% and keep the government happy. So it's all a nice roundabout, making money for the investment banks. And it's never been clearer that the corruption is entrenched right now. And this is the Chinese form of government that we are living in the next while. Now, I'm sure Jen's saying stop waffling, but it's important to know they're going to keep the money pump going so they can get more inflation and get asset prices higher. So they're borrowing for free and investing at 1%. You can do that all day, every day. And you're borrowing from the same, effectively the same credit person as you're lending to. So if the Federal Treasury goes down, you basically say, well, sorry, you lent me the money. I had that, you can walk away. So it's a brilliant scam, the best scam in the world you've ever seen, and it will continue. What happened here on the E-mini S&P we saw was that top. We got short up there. Now there's much higher targets higher above. John and Larry alluded to the fact that they're, this is still going higher, and I agree. There's just no way that the end of the world is here, despite the fact that when you look at most indicators, you see massive divergence. The money pump runs. The reason why the Australian stock market has not gone up is fairly clear, and that the fairly clear part is we're not pumping enough money. The RBA has only pumped $120 million. It's only lent $120 billion, I'm sorry, to the government, so the government can give money to people not to do anything while farms go empty and food goes pressed into the ground because people don't have to work. Universal basic income is fantastic if you want to starve people, because what happens is when people get money to do nothing, they don't have to do anything. They don't have to go out and pick up food. And what I think Ken alluded to was universal basic income. This is a proposition of the World Economic Forum. It was seen as a conspiracy theory, but now what it is mainstream with Atasia, what's her name? and AOC they call her, and all those crazy people who are in control. And we're getting more of this. So it's going to be very hard to get anybody to work when they get paid to do diddly squat. So look out for your food supply. Make sure this is doomsday preppers and all those sort of things. Those people were right. You're better off bloody making food in your backyard. That's why the price of land's gone up a lot. People are recognizing this. You've got to learn to grow your own food because it may just disappear at any moment, like toilet paper in a pandemic. So as you can see, the All Ordinaries itself has bottomed on a 1-to-1, looking for 71.56 on the top side. We don't see that in the All Ordinaries. This is just the shorter term, sorry, in the ASX 200. We've been looking for 68.38 for a while, so we're looking to reach short temporarily up there. You'll notice the swing is still down on the charts, even at this point in time, just missing ticking self up today. So I wouldn't, I kind of, the XJO has been behaving poorly. It's all been in the small caps, which is usually a sign of a top temporarily. So small caps, you'll notice here, we've got some divergence. We've got 3 drives to a top. It should probably come back to 30.11, but God only knows what it's going to stop. People are buying all the little gold stocks and silver stocks and all that sort of stuff. I'll move on a bit into the Australian section now, and I'll go back to gold for people who like that sort of stuff. So Davos struck. Davos was the reason last year why I spent a lot of time wanting to short in mid-February. I predicted mid-February would be the time to short, and we got a very good bang for our buck. Biggest trades short on the S&P and the NASDAQ that we've ever seen. So we'll talk about the Australian stock market here. We've got different things, and this was ASM. Okay, forget about that. That's another question. I'll just move along here. These are the questions this person asked. My forecast was for the All Ordinaries, this is for 2020. I'm sorry that I didn't have it up there, that the market would top in February and that it would go down into middle of the year and then go up. It actually bottomed in March, as we all know, around about the 25th of March. We went long and everything was happy. We looked for the end of the year to be quite cheery, and people who saw my forecast got that as well. Okay, so at the moment, most things would say this has to be toppy. This is the 2020 forecast for the XJO, also topping in January, February, going down into July, and then finishing the year well. This is based on WD Gans mass pressure chart, and it showed that basically after June, July, we should be getting long, which we did. And so it was a very cruisy year last year for Profit Hunter Group members, and people just loved it. I loved it. It was awesome. It was so easy. And I've got to say, trading has, and this is probably going to put the kiss of death on me, but trading has just been magic. For example, gold bottomed and doubled itself, as I've showed to my Profit Hunter Group members lately, 100% up to that previous top last year. So these markets are the best trading that I've ever seen. They're the most corrupt, but that's really cool. Goldman Sachs is currently telling us to buy dips, any dips you want. And that's a bit of a preparation for the next couple of weeks. It won't be in the long run a sign that it's always going down, but for the next couple of weeks, you can be assured Goldman Sachs is doing the right thing and probably selling rallies, looking to crack the market down again. All Ordinaries 2021, looking to top over this little period here. And these are monthly resets, remember. So we see 1, 2, 3, think January, February, March, April, May, June, July, August, out to the end of December. So what we see here is that we've probably got a little bit of a collywobbles into July, August, a rally up into November, and then the usual panic down into December so that we can buy for Christmas and get a bit of a rally, although this rally doesn't look like it's coming in for whatever reason that is, maybe just a short-term thing. So there's some beautiful things that I saw in the charts recently. I'll show you what we've done in silver. Now, I've been a fan of silver for quite some time. And this chart here is the gold-silver ratio. And Kendo was talking about it. And I don't know, well, you were talking heavily about gold, but I don't know if you did the gold-silver ratio. So I've been looking at gold-silver ratio, and last year I started to say, this is out of whack, 126 times, whereas before it was down in the 30s on this low here. And generally it was groveling up to 80, that sort of area. And this is back to 1997. So 80, 80, 80. This is around the early 80s, and it blew its top off, went to 126. It had to come back at some stage, and we're seeing that with silver at the moment. So we've seen that big decline. If it ever gets back through 70, look out for a run back up to 82 and maybe 87. So that's the kind of thing that I've been looking for. And we've seen that with gold and silver. We noticed that the gold stocks have been quite weak. This is gold. The gold index, right? Gold's been weak. With all the money pumping, you would think that it would be a gala for gold against the US dollar. But no, it's not. It hasn't been. Why is this so? The answer is because Bitcoin now has greater open interest than gold on COMEX. Believe that at your peril. You'll notice that when they created Bitcoin futures, this was the high at 20,000. They created Bitcoin futures so they could slam back down Bitcoin, short it up here. It didn't take much, because obviously institutionals getting amongst it when it's only $1 trillion worth of, right now, it's only $1 trillion market cap. Doing swaps, you can do whatever you like. Notice also that back when Bitcoin was on its lows in 2017, wonderful Jamie Dimon was telling us to short. Don't ever come near Bitcoin. Don't do it, don't do it, don't do it. And at the same time, his lovely traders were buying as many Bitcoin as they could pre the run up to the 2017 high. Then they got the chance to short it because they were holding Bitcoin. They shorted it using futures because they were hedged, and then they rammed it back down to 3,000. This is beautiful manipulation. It's the perfect thing that you want to see. There is untouchable corruption, untouchable manipulation going on in these markets. If you don't think there is, you got another thing coming. The Reddit boys, let's talk about the Reddit boys, because they're not generally girls doing it. They're the young warriors. Instead of picking up and getting angry about politics of what's going on in the world and the lies they're getting, they're having a go at the banks which are short silver. One of those is JP Morgan, which is Jamie Dimon's. They've been having big shorts on. They also hold SLV. They're the custodian for SLV, which is the largest ETF in the world for silver. Now, silver, you'll notice here it's just done a double top, $29.91 and $30.35. Now, I have been encouraging people, because of the gold-silver ratio, to prefer gold over silver, silver over gold. And it's been working. We've had, I think we had a trade around that 12 bucks. We've been trading in and out of this like no one's business. We got stopped out just before it went up, and I thought, bugger this. So we got back in at $25.20. We've been taking chunks out of it. And last night, I was bothering myself looking at the silver chart. So where was it? This is 7:14 a.m. Where are we? That wasn't last night. That was where? Silver trade. Okay, that was 11:14 p.m. last night. Okay, here's what I said. We've been long at $25.20. We'd also been buying Silver Mines SVL, which is an Australian silver stock allegedly. So here at that time, silver trade, now trading $29.80. Let's take profit on 1/3 at $29.80 and run the stop loss up to $27.90. This is for my commodities members. Okay, so what do we see here when we go back into there? We see that on the daily charts, it's gone 1-to-1 on that big range up. 30-25, if anyone remembers the mathematics of 30-35, 30-25 is actually 55 times 55. So I quite like that, but it wasn't the top. Anyway, we've seen, so we took profit up here. We've now been stopped out here on the balance for an okay run up from $25.20. Now, that 1-to-1 is something that we saw. We're seeing a lot of 1-to-1s. They're just absolutely fantastic lately. Give me 2 years ago and I'd be saying, fuck 1-to-1s. I hate them because they don't work. Beautiful stuff going on here. Anyway, we're getting pumped. So what you've got to understand with the Reddit people is they're only speculators. They're going to get the rules changed on them. They're going to get crushed and they're going to get burnt. They may be attacking these people. And once I saw all people, everyone talking about it on the news yesterday, I thought we were really near a top. The other one was Silver Mines. Now I bought some Silver Mines and we got in for a PHG trade at 21 cents a couple of days ago. And I'll show you the chart here. So we got in, this here was that low. So we bought it on this day here, which was Thursday, I think the 28th. And basically, I kind of got a thing where if I see myself get up 50% or 100%, which was on the SLVOB Silver Mine options, I got to take some profit. So I took some profit and I said, okay, let's expect back down to 27 cents. I actually said 27 cents, but the old top was 26.5 cents. The high yesterday hasn't quite filled the gap. Tonight in trading, you've just seen that movement back down. So we took profit yesterday for some, got back in some today. Now I'm starting to worry that this doesn't work. So like we've got this silver scam. The Reddit people eventually have to take profit or they get the rules changed or they end up holding stuff that they can't deal with. The big run where they first did this was Hertz, if I remember, with the Robinhood traders. Now, these are people who are trading for free. They don't want to pay brokerage. The broker Robinhood shares information with the investment banks and the what are they, hedge funds with from the Robinhood retail traders. They exchange that for being raped and pillaged because they know their positions and their cannon fodder and liquidity for the hedge funds. So eventually this silver run is just bogus. It won't last. They're doing a ripple run. Watch these people, get in, use them, make sure you take your profit when they're actually in. Take your profit fast is what I'm advising. This is good, great trading, and it's going to get more spectacular. And it's all Joe Biden's fault. As much as I hate the man, and I believe he's a robot and he's a piece of shit and a complete liar. And he is also being paid by the Chinese Communist Party through his son, Hunter Biden. If you think that the Burisma scam is just one of their scams and it's the biggest scam that they have, no. They're getting paid through Costco, the big CCP shipping company. It's all clear and it's all traceable and it's all true. But that'll all be seen as conspiracy theories. So what we're seeing now is with gold is continued weakness right now tonight. And look at this. This is just rubbish. It's just rubbish, really is. So one of the problems is when we look at the US bond market, we can see rubbish. Okay, notice this top, it's broken, violated, and I've been on the negative side for quite some time on the bond market. I'm too scared to actually short it because we're short TBT actually, sorry, that's not true. which short using TBT, which is the ETFs. I'm hoping to sell up to 176. Previously, I was hoping to sell up to 183, but it just never starts, oh, sorry, this shit in my eye. It just never stops. Never stops just grinding down because they're issuing so much bonds. Going back to the bonds, this is part of my forecast. I'm sorry, is this all right? I am rabbiting on a bit about, because I'm really pissed off the way they've run the world. And the liars win. This is the commodity section, and this is the forecast. This was the doubling. If you notice here, we've got basically gold doubles, high to high, low to low, give or take 4 months. So it doubled on that top. So I've been saying I don't expect gold to make a new high for quite some time. And I've been saying that for quite some time because the low, I think, was at 1048. It doubled itself up to, I think, 2086. Is that the gold top, if I remember correctly? It's anybody feel happy to correct me because my memory's not as good as it used to be. Okay, so 2089, that was the top in gold. The low over here was, what was it? 1045. So 1045 times 2, that's 2090. Perfect time to top out and go back down. So when John and Larry talk about the 1600 area, beautiful guys, that's our target. Slightly below the old tops. I'm worried about a breakdown below 1796. The Aussie gold stocks have been strong, and yes, I concur with, I think both Larry and John was saying, basically, I'm looking for 75 cents on the downside, plus then a push up to that generally 80 cents area. It might go 73 cents on the downside. One of the trades that I've been having on, which was for the dollar index, and I like the dollar. I don't know why I should, but I've been liking the dollar. We took profits today, and we've also taken another bit of profit now on the US dollar index on a trade we've been having on since, I might show you this. Where are we? That's annoying. Just go back into the dashboard. So I have these things called profit owner group trades, and people trade off them. Generally, it's professionals like commodities companies. I've got a lot of brokers who trade, actual stockbrokers, ANZ and Short Stockbroking and Morgan's itself, who use my stuff. So, okay, this is in Forex. We've been long since early January. That was okay. I picked that the dollar should bottom around late December, early January. So then what we did was bought a breakout above 90, and if stopped out by dips to 89.47 with 89 with 89 target, or with an 89 cent stop. Anyway, so the stop loss has gone up to 89.80, 90.08. We've had some targets towards 91.14 and 91.33. Now, I gave some orders to take some profit today, and that hasn't shown up on this, or yesterday. We took profit a little bit lower down on 1/3, and I don't know why that's missing, but I have to change that in the morning. I won't bother with you. We took a profit on 1/3 just here because it went 1-to-1. It's gone a little bit further, so there's a bit more in the tank, and there was a 1/6 take profit, I think at 91.14. So we're not quite filled on that. This is an ABC retracement, and as you might see, volume is not wonderful on the upside. So while I like to think the US dollar index cycle-wise should go up, it's still weak, and I agree with what John says. So sorry, I'll bounce around a bit when I just to talk about things. So this is gold, and it's kind of violent. This is my forecast for gold. It's kind of violent with a possible early March top, a drop down to early July, and then a rallying up into August, mid-August and November. That's my one. And silver hasn't been working to the forecast, which is different to my trading, but we may have seen a late shift with this Robinhood stuff. And you'll notice here on silver, the top thrown was back over here, so it's not really a top early January. If it wasn't for the Robinhood bullshit and the Reddit bullshit, that top wouldn't have been taken out. So this is squeezed up. It's kind of a scam. There is actually some rumors that it's hedge funds actually buying it, and we now have a double top. So you want to be careful about that. And I'm beginning to worry about my silver mines position right now. Okay, this is the 30-year bonds forecast. This is what the forecast looks like down into early July and then up into November. Now that early July means it's safer after early July because that's the swing there. Sorry, it's graphically a little bit hard to watch. And a rally up in November. Whether this is just a bear market rally, I can't work on that too well. Oh, sorry, that was last year. That was 2021. This is 2020. Looking to sell in May and go away for this year if we get a rally. At the moment, it's a bit turbulent, although probably around about now, then a rally up for a little bit of shorting in, selling in May and go away. One of the things I look at is long-term charts. This data, for whatever I've got, is the 10-year bond constant maturity yield on the US. Back since the US was a twinkle in the eye of George Washington and the founding fathers. We noticed that around, this is probably somewhere in the mid 1930s that this low came in, around about 1%. And we noticed that it went up for, let's just say, 40 years.
Yeah.
20,
I think that low was 1941, David.
Okay, that was during the war. Okay, cool.
Day before, the day after declaration of war against Japan.
Ah, okay. When they needed to start funding all the blowing up of stuff and doing what they do best. So that 41. So thanks, John. So that's 41 to 77, which is how many years? Let's talk about 36 years. 77 downwards. So add 36 to 77. What number do we come up with then? I want to look for equality in time. So 77, but let's call it 3. Let's call that 83, 40 years, 2023. So that's when we should start to see a massive rally in yields and fall in bond prices. That's the time where once that's done, all of the debt will come home to roost on anybody who's over leveraged. And that's when the housing markets really are geared for the end of the move. We'll see it maybe low around that time, 2023. So look out for your property prices in 2026. That's when a lot of the cycles, the 18-year cycle in property starts to come out. So this is not advice, but be cautious around that time if you have 74 leveraged properties and you feel like you're a gazillionaire, because it'll be a lot of trouble, especially if the World Economic Forum's plan to reduce population from just now nudging it's about 200 million off being 8 billion. They want to pull it back to something that some documents I've seen from the World Economic Forum and a couple of the other ones that are associated with it, the Rockefeller Institute, they're looking for 2 billion people on the planet or 500 million people on the planet. Universal basic income is the way that they want to achieve it. Okay, that's probably, we're getting close to the end. I don't know what else I want to cover at the moment. I've been very big fan of the grains. And I've been a big fan of commodities in general. And this has been an extraordinary move in corn. It was groveling around 320, up to 555. We've got soybeans in the teens. I look very closely at the grains because one of my clients is probably the third biggest grain company in Australia. It's a privately held enterprise. And what we see here is at least we're getting soybeans starting to worry itself back down to where it's not in the teens, maybe around 12 bucks. So we might get some reprieve on those. Things like, I covered things like nickel, which has been just a wonderful run. Trading Western areas is harrowing, but it's really good fun working off the nickel price because it's kind of a delay. And only trouble is I want to see Western areas back to $2. BHP, I've been talking about $50.20 on for a while on BHP. And we'll have basically a triple top up there, the $50 from 2008. Now my forecast 2 years ago was saying that we expected a commodity boom into 2020 and with a retest into 2022. So what we're seeing here is $50.20 as a triple top target. If it takes out $55, it's going towards $100 again on BHP. Always good to be working with BHP, but at the moment limit expectations to that triple top there. What time is it? 10 o'clock. Shit, this is long. Ken's already about asleep. He's trying to tap his head to stay awake.
We've been very fortunate. We were booked in till 9:30, so 35 minutes past that. We've been very fortunate.
The other thing we were doing was volatility. That I think I explained that. Volatility I thought was kicking up. Now it's whipped right back. So luckily we took some profit on Friday for that 35.20 area. You just keep look. What I like to do this year is to keep buying around that 20 area and wait for it to spike up again, because the amount of stupidity that's going to be going on is just going to be unbelievable. Thank you all. I hope that was not too boring and you got something out of it. A good one.
Okay, thanks very much, David. And thank you everyone who presented tonight, Larry, Ken. Just to finish off, as if anyone has any questions, now's the time to ask them. Just unmute yourself and identify yourself and call out your question. Well, thank you very much for everyone for attending. Very informative ideas there, and yeah, they're just people's ideas. So I hope everyone gained something out of that and help them set their own directions for the year ahead. Do look out for our in a month's time when we put our notice around for our next meeting. I'd love to see you all again. So thank you very much for attending tonight, and happy trading.